Hey, good morning. So I get asked from time to time about self-employment and how the taxes work for that. And one of the things I hear often is, I don't have to pay any tax on my self-employment income until I make at least $400. And that is true if you have only self-employment tax income. If you don't have a day job, a W-2 income, or any other income, and all you made was, let's say, $350 doing some kind of side gig, then yes, you don't have to file taxes, because you have to make at least $400 in order to owe self-employment tax. Self-employment tax is different from federal income tax. So you have three components that make up what you owe when you file your Form 1040 with the IRS. You have federal income tax, Social Security, and Medicare. Social Security and Medicare are also called employment taxes. They're also called FICA. And when you add those together as a self-employment person, it's 15.3% of your self-employment income. The reason it's so high is, as a self-employed person, you're paying both the employer portion and the employee portion of Social Security and Medicare. When you work for a business, you only pay half that. You only pay whatever half of 15.3 is. And the employer pays the other half. And so the rule is, if you make at least $400, you have to start paying Social Security and Medicare. And it's actually called the SICA tax, SICA. It's like Self-Insurance Care Act, something like that. And but it's essentially, it's FICA, and it's both halves. And you fill out a special form for that called the SE schedule, and it gets attached to your Schedule C, profit or loss from business, and you pay your taxes. Now, if you have other income, then that's on your, that's your W-2 and so forth. You pay federal income tax on that, and your employer is already withholding the FICA on that, so you don't have to worry about any of that. It's just the self-employment side. But you can make, as a single filer, you can make up to $16,000 before you owe any federal income tax. As a married filing joint, it's double that, $32,000. And the reason is because that's the standard deduction. So Trump, in his first term in office, raised those standard deduction amounts up significantly. And because of that, fewer people have to itemize on their tax return in order to get a sizable deduction from their income. And so the lowest category of tax filers can take advantage of a significant deduction without having to own a home and write off things like mortgage interest and real estate taxes and all the things you see on your Schedule A to itemize, which also includes state and local tax, health expenses, medical expenses, if you've got a significant amount, because you really need above 7.5% to write any of those off. You can only write off 7.5%. You can only write off the medical expenses that exceed 7.5% of your adjusted gross income. That could be a significant amount if you have an average AGI. But also your charitable contributions and gambling losses, as I mentioned in a separate video. So, the way this works is you add all those itemized deductions together, and if it's more than the standard deduction, then you take the itemized deductions. If it's not more than the standard deduction, you don't have to worry about, adding all that stuff up and putting it on the Schedule A. You just put that standard deduction number on your tax return, and if it exceeds your income, you don't owe any tax. And so that's where that 16,000 number comes from. And but if let's say you make $10,000 self-employment, you will owe no federal income tax because it's below the $16,000 if you're a single filer. If that's all you made, you'll owe no federal income tax, but you will owe the Social Security and Medicare tax, which is the self-employment income of 15.3% on your profit. And so this is where it comes into play, where you can write things off, like your business miles, for driving your car, any kind of equipment or gear you bought, for your business that you use exclusively for that business. That's a whole separate video, but you just, at this point you've got a business and you can write those things off that profit or loss on your Schedule C to arrive at the amount that will then get taxed as self-employment income. So hopefully that makes sense. If not, leave me a comment or question, and I'll try to address those. And if you are enjoying this video, please like and subscribe. Thank you.